Hello and welcome to March 2nd. Alphas lead with XLC at 10% as a put. That's correct. We have a put now in the lead at 10%. Maybe we'll be getting into that dip of the market that they've been chatter about on the various platforms and stuff. We'll see. But remember, I trade by the individual stock, not to the market. So if the market's trending up, but my scanners don't give me anything of entry or any possibilities, we don't do it. So let's get ahead and talk about the winners for today. And I'm going to give you a little sneak preview into what my routine is. So here we go. XLC is at 10%. It is a put. There's our stop here at 73. Let's see, it's going to be at 73.95. So it's just above that marker right there. And the indicators down below are starting to weaken. Look at the green. It's starting to little flatline and thin out. The stochastic is almost flatlining, and RSI is dipping down. Now, the one you see down at the bottom here that I don't speak often is the ATR. I usually leave it as a flat line because I use the ATR in my calculations to figure out what is going to be, how many days I'm going to be needing to the trade, and how many days it's going to take to get to that third ratio. I was anticipating 3 days after getting into this trade. Now, when was this trade triggered? So we'll come over here to XLC and you right click, come down view trades, and there the trade was triggered on the 19th at 9:38 in the morning. And I believe that's set to California time. Yes, I think, pretty sure. Yes, it is because I see 6:30 here sometimes when trades get taken off at the beginning of the day. So there is the entry time, and the 19th was way back here. There is the 19th right there where our feeding lot should be tracement is at. There's our 3-to-1 ratio that we're anticipating to get to. We are risking 1 unit right there, 1 to 3. This is what the whole theory is. And the Elvis Shift is, well, we'll talk about that when I get into my routine. Okay. Sorry about that. I get so wound up in my head. All right, so that's our leader for the alphas. There are XLC and the puts on the call side. We have Capri running at 8%, and there is Capri right there. There's our risk of 1. There is our target of 3. Let's see what Capri's time was triggered. It was triggered on the 22nd at 6:34. I'm correct. This is California time, Los Angeles. So here we are with Capri, and it's sitting at 8%. So it's got to work its way up here to get that at 30 ratio, so we can initiate the first exit rule, and that is lower high, lower low, lower high. The V shape right there. Look, higher low, higher low. We're looking for this pattern. There it is again, right there. The pattern's right there again, and the pattern's right there again. Well, we need that pattern here. We need it up in this. We need, first of all, my apologies. We need a close up here. We get a close up here, and then we'd start looking for this pattern. It doesn't matter where it appears, if it appears below or above, but the bottom line is that price has to break above the third ratio. So price closes above the third ratio, then we start looking for this pattern for the out. Unless, and you saw it happen last week, guys, ROI 100s. ROIs 100 show up on the screen, and we'll be looking for last bar low to take that profit off the table. All right, let's go into the sneak peek, guys. So my routine is after I finish going through, and then I go through all these and make sure that there's no changes in their exits. Then I come here to this one called activities and positions. Why? Because I got to make sure that I don't forget that I might have outstanding orders. Now, how would I know I have outstanding orders here? Well, you come down and you don't see any blue. If you have any outstanding orders, what we call waiting for condition in blue, or turquoise is the color they're using, the bottom line will be is that that's the open position, and then I have to go check it out. There is none here. So we'll go back to our account statement, and there we are back at our account statement. So now the next thing is we run the scanner. That's correct. We run the scanner and we come over here, and I just ran the scanner for the downside. And remember that we had an Elvis Shift yesterday where price now must close below the 10-day moving average. Let me hide that. Let me do it this way. Oh, here we go. Here we go. That area is not being used. So price has to close below this average. Now let me make sure that I got the right average in here, because sometimes this one has not been changed yet. I have to now update all the charts as I go through them, and there it is. There's your 10-day. So I need the price to close above the 10-day moving average, along with the indicators in the right direction for me to consider a trade, and then determine my exit, my entry, my exit, and my 3-to-1 ratio. So that's what happens there. Let's go back to that position. Yes. So there we are. So we had nothing in the downside. So let's go to the upside. And in the upside, yes, we have. We have here availability. We have 1, 2, 3, 6, 8. We have 8 positions of potential. Now we had this happen the other day, yesterday, and nothing came up that qualified because the options were too wide. One of the leading contenders, and let's bring that one up on stage now. The leading contender for yesterday was hopefully going to be ATVI. But look what happened. Right there in nice big red letters. The spread was too wide. The spread was too wide. We repeat it twice. Repeat it 3 times. If the AB is too wide, you're going to say, now, for new people who are not familiar with all these terminologies, that means it's the bid-ask price. It's similar when you're buying a house. The person asked $300,000. Oh, that'd be a very inexpensive. That would be a very inexpensive house in LA County. But in other parts of the country, it's a decent price for a home. And then you turn and counter and say, I'm only going to pay you $250. That's your bid. That's called the bid-ask price. So on the options chain, we come to the options chain, and there it is, ATVI. And then I look through here, and because this account is at $5,300, it's about $140 short. The bottom line is, and we have about $2,300 in buying power. We only can buy an option that is at $5.38. You see that? 10% of this, and that makes it 538. 538 divided by 100 makes it $5.38. So $5.38 means I only can get this option right here. That's the only one I can qualify, and that's not bad. It's close to it's not bad. It's the 33 delta, but here's the problem. It's more than 10%. There is a perfect example. Again, more than 10%. More than 10%. Stop the video and then do the calculator. You can say, oh yeah, you take the high price minus the small price, divide the remainder from the division, from the subtraction, and divide it by the bigger price, the ask price, and it'll be greater than 10%. And that is the first disqualification. You don't take the trade. That's it. So that is a peek of what I will be doing. So what will be happening is, and again, I have to verbalize this. These trades are my trades, and you need to do your own due diligence if you're going to follow through. But that's a peek of what I'll be doing. And that's my routine. I'll go through here, and then if I don't find anything, guess what, guys? Keep the money in the bank. The 2317 will stay right there. Just like yesterday, I had 4 candidates, and it didn't happen. And today we have 8. We'll see what happens. And with that said, we're going to go ahead and conclude today's report for Losers Become Winners from March 2nd on XLC at 10%. And I'll thank you for stopping by and checking it out. Bye-bye.